What's up everybody, it's Moneymaker here and welcome back to the channel. Today, we're diving into the world of trading with a focus on trend indicators. These tools are absolutely crucial for any trader looking to make smarter decisions and maximize their profits. Whether you're just starting out or have been trading for a while, understanding how to identify and analyze trends is essential. Trend indicators provide valuable insights into the direction and strength of the market, helping you make more informed decisions about when to buy, sell, or hold your assets. Throughout this video, we'll break down 6 powerful trend indicators that every trader should know. We'll cover their mechanics, how to interpret them, and most importantly, how you can use them to your advantage in your own trading journey. So, buckle up, grab your notebooks, and let's get started. Alright, let's kick things off with one of the most fundamental trend indicators, moving averages or MAs. Now, MAs might sound intimidating, but trust me, they're actually pretty straightforward once you get the hang of them. Think of moving averages as a way to smooth out the day-to-day price fluctuations in a stock or other asset. Imagine you're looking at a super jagged line chart of a stock's price over the past month. It's all over the place, right? That's where MAs come in. They create a smoother line that represents the average price over a specific period. This makes it easier to see the overall trend, whether it's up, down, or sideways. There are 3 main types of moving averages: simple moving averages, SMA, exponential moving averages, EMA, and weighted moving averages, WMA. Don't worry too much about the technical differences for now. The key takeaway is that each type calculates the average price a bit differently, giving more weight to recent prices or older prices. For example, a 20-day SMA would calculate the average price over the past 20 days. As each day passes, the oldest data point is dropped, and the newest data point is added, giving you a constantly updating average. This helps you see if the price is generally trending upwards, downwards, or moving sideways. EMAs, on the other hand, give more weight to recent prices, making them more sensitive to recent price changes. WMAs also give different weights to prices, but they put more emphasis on the most recent prices, even more so than EMAs. Now here's the cool part. By plotting multiple moving averages on your chart, you can start to identify potential trading opportunities. For example, if you see a shorter-term moving average, like a 50-day MA, cross above a longer-term moving average, like a 200-day MA, that's often seen as a bullish signal, suggesting that the upward trend is gaining strength. Conversely, if the shorter-term MA crosses below the longer-term MA, it could be a bearish signal, indicating a potential downward trend. Remember though, these are just indicators, and it's always best to combine them with other forms of analysis before making any trading decisions. Alright, let's move on to another powerful trend indicator, the Moving Average Convergence Divergence, or MACD, as we cool traders call it. This one might sound a bit intimidating, but stick with me because it's actually pretty intuitive once you understand the basics. The MACD is all about momentum. See, in the trading world, momentum is like that extra oomph behind a price move. It tells you not only the direction of the trend but also how strong it is. The MACD is displayed as 2 lines. The MACD line itself, which is the difference between 2 exponential moving averages, typically a 12-period EMA and a 26-period EMA. Then you've got the signal line, which is a moving average of the MACD line, usually a 9-period EMA. Now here's where it gets interesting. When the MACD line crosses above the signal line, it's often seen as a bullish signal, suggesting upward momentum is building. Conversely, when the MACD line crosses below the signal line, it could be a bearish signal, indicating potential downward momentum. But that's not all. The MACD also helps us spot potential overbought and oversold conditions. See, if the MACD line moves too far away from the signal line, either to the upside or downside, it could mean the price is getting ahead of itself and might be due for a pullback. Think of it like a rubber band. If you stretch it too far in one direction, it's bound to snap back eventually, right? Traders often use the MACD in conjunction with other indicators to confirm their trading signals. For example, if you see the MACD crossing above its signal line and the price is also breaking above a key resistance level, it could be a strong indication of a potential uptrend. Remember though, no indicator is perfect, and it's always essential to consider other factors like market sentiment, news events, and your own risk tolerance before making any trading decisions. Alright, let's move on to a more visual trend indicator, the Parabolic SAR, or stop and reverse. This one's a personal favorite of mine because it's so easy to understand just by looking at a chart. Imagine you're surfing. You want to catch a big wave and ride it for as long as possible, right? Well, the Parabolic SAR is kind of like your surf buddy, helping you identify those big waves and telling you when it might be time to hop off. Here's how it works. The Parabolic SAR appears as a series of dots that plot either above or below the price bars on a chart. When the price is trending upwards, the dots will appear below the price, like a trail following behind a rising rocket. As long as the price stays above those dots, it's a sign that the uptrend is intact. But here's the cool part. If the price drops below the dots, the Parabolic SAR flips, and the dots start appearing above the price. This is your signal that the trend might be reversing and it could be time to consider selling or taking profits. Conversely, when the price is trending downwards, the dots will appear above the price. If the price rallies above the dots, the Parabolic SAR flips again and the dots appear below the price, signaling a potential trend reversal to the upside. Now, the Parabolic SAR is known for its ability to catch big moves, but it can also generate some false signals, especially in choppy or sideways markets. That's why it's best to use it in conjunction with other indicators, like moving averages or the MACD, to confirm your trading signals. Think of it like this. The Parabolic SAR is your go-to indicator for identifying potential trend reversals, but you always want to double-check with your other trading buddies before making any big decisions. Alright, let's talk about the Average Directional Index, or ADX. Now this one's a little different from the other indicators we've covered so far. Instead of telling you the direction of the trend, the ADX is all about measuring the strength of the trend, whether it's up, down, or even sideways. Think of it like this. The ADX is like a power meter for the market. It tells you how much juice is behind the current trend, regardless of whether it's bullish or bearish. The ADX is plotted on a scale of 0 to 100. Generally, readings above 25 indicate a strong trend, while readings below 20 suggest a weak trend or a ranging market. Now here's where it gets interesting. You can actually use the ADX to filter your trades and avoid getting chopped up in sideways markets. See, if the ADX is below 20, it might be a sign that the market is just drifting around without a clear direction. In these cases, it might be best to sit on the sidelines and wait for a stronger trend to emerge. But when the ADX is above 25, it's like a green light telling you that the market is ready to move. This is when you want to pay close attention to your other trend indicators like moving averages, the MACD, or the Parabolic SAR to identify potential entry and exit points. Think of it like this. The ADX is your market strength coach. It tells you when the market's pumped up and ready to make big moves and when it's just going through the motions. By combining the ADX with your other trend-following tools, you can increase your chances of catching those powerful trends and avoid wasting time and money in choppy, directionless markets. Alright, let's dive into a more advanced indicator, but trust me, it's well worth the effort, the Ichimoku cloud. Now this one might look a little intimidating at first glance with all its lines and shading, but once you understand its components, it can be an incredibly powerful tool for identifying trends, support and resistance levels, and potential trading opportunities. The Ichimoku cloud, also known as the Ichimoku Kinko Hyo, was developed by a Japanese journalist named Goichi Hosoda in the 1930s. He spent over 30 years perfecting this indicator, and it remains one of the most popular and versatile tools used by traders today. So what makes the Ichimoku cloud so special? Well, unlike many other indicators that focus on just one or two aspects of price action, the Ichimoku cloud provides a comprehensive view of the market by combining multiple data points into a single, easy-to-read chart. The Ichimoku cloud consists of 5 lines: the Tenkan-sen, Kijun-sen, Senku-span A, Senku-span B, and the Chiku-span. Don't worry too much about memorizing the Japanese names for now. Just know that each line represents a different time period and calculation, providing insights into the market's trend, momentum, support and resistance levels, and potential future price action. One of the most visually striking features of the Ichimoku cloud is, well, the cloud itself. This cloud is formed by the space between the Senku-span A and Senku-span B lines, and is shaded either green or red, depending on which line is on top. A green cloud, where the Senku-span A is above the Senku-span B, generally indicates a bullish market, while a red cloud, where the Senku-span B is above the Senku-span A, suggests a bearish market. Think of the cloud as a visual representation of the overall market sentiment. Traders use the Ichimoku cloud in various ways, from identifying trend direction and strength, to spotting potential breakouts and reversals. For example, if the price is trading above the cloud, it's generally considered a bullish signal, while a price below the cloud suggests a bearish market. Alright, let's wrap things up with another powerful trend indicator that can help you identify those big market swings, the SuperTrend indicator. Now, true to its name, the SuperTrend indicator is designed to highlight the underlying trend in the market and filter out those pesky sideways movements that can lead to frustrating whipsaws and false signals. Think of it like this: the SuperTrend indicator is like a trend-following superhero, cutting through the noise and showing you the true path of least resistance in the market. The SuperTrend indicator is typically plotted on a price chart as a line that trails either above or below the price bars. When the price is trending upwards, the SuperTrend line will appear below the price, acting as a dynamic support level. As long as the price remains above the SuperTrend line, it's a sign that the uptrend is intact. But here's where the SuperTrend indicator really shines. When the price breaks below the SuperTrend line, it triggers a sell signal, suggesting that the uptrend might be reversing. Conversely, when the price is trending downwards, the SuperTrend line will appear above the price, acting as a dynamic resistance level. If the price breaks above the SuperTrend line, it triggers a buy signal, indicating a potential trend reversal to the upside. Now, what makes the SuperTrend indicator so powerful is its ability to adapt to changing market volatility. Unlike traditional moving averages that use a fixed time period, the SuperTrend indicator adjusts its sensitivity based on the market's volatility, making it more responsive to sudden price swings. This means that the SuperTrend indicator can help you stay on the right side of the market, whether it's a calm and steady uptrend or a wild and volatile downtrend. By following the SuperTrend indicator's signals, you can potentially ride those big market swings and avoid getting shaken out by short-term fluctuations. And there you have it, 6 essential trend indicators that can help you navigate the markets more effectively. Remember, these indicators are your trading companions, providing valuable insights into the market's direction, strength, and momentum. But like any good team, it's essential to use these indicators together, combining their strengths to confirm your trading signals and make more informed decisions. Don't be afraid to experiment with different combinations and find what works best for your trading style and risk tolerance. Most importantly, never stop learning. The market is constantly evolving, so it's crucial to stay ahead of the curve and continuously expand your trading knowledge. Don't forget to like, subscribe, and hit the bell icon for more trading tips and strategies.